Hey everybody, this is Nick with OCI. Bear with us here. I know we said we were going to get this started at 1:20. We're having a couple technical difficulties. Give me 2-3 minutes here to get things set up.
Hello. Good afternoon. Dan, can you hear me?
Yeah, hey, this is Nick.
Hey, Nick.
Is this Michael?
Yes. Yes.
Michael, perfect. Do we have your screen set up? We are live here, so I'm not recording yet, but if we can get your screen, I can shoot the share screen over to you.
Yeah, go and shoot it over. Let's see what happens.
All right.
Go on my side. It should change my little box here and allow me to.
There you go.
Show my screen. And I am going to make this small. Make this big. What do you know?
All right, I can see it. So again, everybody.
Thank you very much, Nick. Everyone put your seatbelts on. Thanks for joining us. I'm going to go pretty quickly. It's not rocket science, but it's certainly listening to and paying attention to, because it's not the normal story of life insurance, and that's probably the neatest thing about this whole program. So basically what we're going to talk about today is life insurance you don't have to die to use, right? And some people may be familiar with chronic illness riders or long-term care riders. We're going to take it a step beyond that to something you've probably never heard of before. So we're going here, as long as I can keep my slides moving. So what we're going to talk about today is how we're revolutionizing the way insurance is bought and sold. And here's the key: to show you how to turn a liquid death benefit into a liquid pool of money your clients can use to protect their portfolio assets from costs of severe illness and the risk of outliving their assets, so that they can achieve a higher sense of the financial security during their retirement. So that's the so what of it. That's what we hope to accomplish here today. So really, one of three things is most likely going to happen to most clients, right? And the first is just, hey, they could die too soon, right? And that's what life insurance is for. That's why we buy it. You could get sick along the way, and that's what people are learning is a very expensive endeavor. And if you haven't planned for it, it's going to mess up people's finances and families in the future. The good gene pool, get this one, could live too long. Well, that's a great situation to have happen. It's expensive because you a lot longer than you planned, and your nest egg may run out before you're ready. So let's look at this financial spectrum, and we could argue about the years and so forth, but at the end of the day, I think most people are going to agree we're oversimplifying this, but there's three basic stages here. There's the building asset stage, and that's where up until retirement, you have life insurance for income replacement purposes primarily. In the next stage, you really kind of get into more of a protecting the assets, because the big thing that can blow up someone's family plan and finances is suddenly having a long-term illness or chronic illness. And that's where a chronic illness rider or protection is extremely important. The third stage, if you're from the lucky gene pool and lucky enough to live a long time, is actually living a long time and maybe running out of assets because you actually were healthy. So we'll talk about how to deal with all three of those. So let's talk about the first one first, just building the asset phase. Hey, you could die too soon. Do you have good life insurance in place to take care of you? And so what we have is a GUL contract that this is based on. And everyone knows GUL, generally speaking, it's guaranteed for life and never develops any cash value, right? Well, that's the simplified variety. Ours is better than that and has a couple more bells and whistles on it that really doesn't cost anymore. The first thing that we have on it worth mentioning is that we have 2 return of premium options built into our GUL contract. And, well, I thought I had a slide specifically on it, but basically the return of premium features are 2. One at the 20-year point, as you see in the middle of the triangle, and that would get 50% of your premiums back, and you walk away from the contract if you exercised it. The second one occurs at the 25th year, and you get 100% return of your premiums back, and of course you walk away from the contract. But how our secure lifetime GUL is built, obviously there's guaranteed premiums and death benefits. There's guaranteed cash value. If you ran this out to age 121, the cash value is actually endowed in the contract. So if you had $1 million GUL, there's actually $1 million of cash at age 121. Very unusual in the GUL market space. Lastly, and this is the spin we're going to be able to describe today, is that you can also have a 100% return of premium beginning at age 85 with a combination of riders should a client decide they want to get some of their money back out of their contract, even though it's a GUL policy. All right? So that's just a quick shakedown on what the Secure Lifetime GUL 3 looks like. Let me describe one more thing that I love about this contract. We used to call this one in our materials optionality, and I know that's not a real word, but optionality refers to the fact that you can make changes to your contract down the road without destroying the contract. So let's say you've got a male age 65 preferred. He buys our GUL, guarantees it to 105. He bought $1 million of death benefit. The annual premium is $21,000, and it's guaranteed cash. At age 85, he's got $130,000. Okay, what happens at age 85? I don't know. Life happens, right? Changes in his life, changes in his needs, changes in his business. Maybe he sold his business and no longer needs it, and thinks, well, what do I need this policy for? I'm getting tired of stroking $1,000 checks every year just to pay for this, and because of the business arrangements, I don't really need it anymore. But he decides wisely, but I'd like to keep some of it. Well, with a lot of GUL contracts, you're going to break the guarantees, and after that, it's tough for any policy under service person to drive what you really actually end up with. With our contract, you can make pro rata changes to it. We'll call it 50% in this case. So he cuts the policy in half to $500,000. His premiums are roughly half, now $12,000, and his guaranteed cash at age 85, he's left with $77,000 of cash in the policy, but he was able to withdraw $69,000 of that cash. So he effectively cut the policy in half, got cash out of the policy, and yet has a fully guaranteed $500,000 con going forward. So that's where our flexibility comes in with this contract. This is probably the best things about this contract that we fail to talk about in many cases. It's flexibility. Life happens, right? Here's a little slide going back to the return of premium idea, and in this particular case on $1 million face, it's just demonstrating that the surrender value, like at the 20-year point, in guaranteed cash is only $84,000, and yet if they surrendered it and you had 50% year 20 option, they'd actually get $169,000, right? Likewise, down the road here, at the 25th year, they'd have $212,000 in surrender value, and yet if they exercise the return of premium feature, they could get almost that same exact number out of the contract. So just demonstrating the flexibility of having a return of premium feature that's built into the contract, no extra charge. We also illustrate it these days, and we have a column there. It's that column where you see $118,000 and $294,000. I'll blow it up for you there so that you can see it a little bit better. So we actually put that right in the illustrations so that people can have a better idea. Not that we want people to get rid of it, but what we found for several years is that people were seeing the return of premium in the contract, not even knowing that it was in the contract. So moving quickly on, let's talk, we talked about the building asset phase. Let's talk about the protecting asset phase, right? And that's the one where you don't want to deplete a client's or own estate sooner than what you're really ready to. And that's where chronic illness protection can really shore things up for you. We have a chronic illness rider. Our materials, we'll call it the Accelerated Access Solution. And one of the neat things about chronic illness rider is it's 101G. In the tax code means no long-term care licensing is necessary. The definition is, with our contract, essentially the same as a regular long-term care contract, insofar as when the client is unable to perform 2 of the 6 ADLs or have severe cognitive impairment, and a physician basically proclaims that in writing, the client is able to put in a claim. Unique in our contract, a lot of other carriers have followed suit in this, but not all have, is the situation on the client side does not have to be a permanent one. It actually could be temporary. So in this aspect, we are even more similar to a traditional long-term care policy. Different, though, from long care insofar as it's an indemnity benefit. So no receipts are required. Check shows up once this has occurred, and the clients can spend the benefits on virtually anything that they would like to. Thirdly, we actually can put the rider on in a flexible manner so that you don't have to have 100% of the rider on a contract. Let's say the client bought a $1 million contract. You don't have to put $1 million of the chronic illness rider. You could put back to as much as 50%, or $500,000 in this case. And it's fairly flexible. You can see we go $50,000 minimum to up to a $3 million maximum, just in case people wanted to really load up on the chronic illness. Lastly, of course, we have a built-in waiver of deduction in the contract with the chronic illness rider, such that when a client goes on claim, the base policy, or the life insurance portion, is fully paid, as well as all chronic illness rider charges. So the client will not have to pay any more on their contract at that point in time. The other thing that makes ours unique is we have 3 flexible monthly benefit options. At time of issue, the client has to select whether they'd like a 2% option, which is pretty much what everybody has, 4%, which some companies have, and an IRS per diem with no cap, which pretty much nobody has. And the bottom line there is we have a lot of flexibility. This comes in very handy for smaller policies, for instance. The IRS per diem angle allows you to get at a small policy benefit, but compacts the claim premiums or income into a shorter period of time, therefore making it more meaningful. So said another way, if someone bought a $1 million policy and bought 2% on it, they could have up to $20,000 per month, subject to the IRS per diem limitations. However, so that certainly would be considered a lot. But if you had, for some reason, someone decided to buy only a $100,000 policy, $2,000 per month, is not a very large benefit amount. Consequently, we offer these other monthly benefit amounts, which could pay out, in the case of the IRS per diem option, a maximum of spreading that benefit over 12 months. So in effect, you could argue that it is really an 8% benefit, a 2%, 4%, and an 8% benefit. So that's enough about the chronic illness. Let's go on to the financial life spectrum again. We talked about the building asset phase. We talked about protecting asset phase. Now talk about extending the assets, or what if you live too long, right? And you'll hear me refer to this as a longevity rider. The actual name for our contract rider is not that, but you're going to see me say longevity rider, and that's what I'm referring to. So here's an interesting statistic from Ernst & Young. They say that the average age 65 today, there is a 50% chance that one of the spouses live to age 92, and a 10% chance that one of the couple lives to 105. So people are living a lot longer, and consequently are going to need resources much longer than they used to. How are they doing this? what's the best way to accomplish that? Certainly, we have an interesting rider contract that we can also add. We call it the Lifestyle Income Solution or Longevity Rider. And take a look at these statistics that I think are pretty revealing, that help us make a case for the fact that clients probably want this even though they don't know it necessarily exists. 61% of Americans surveyed say they're more afraid of outliving their retirement than they are of death. So people are very conscious of the fact that they could burn through their money too quickly and then have to rely on family, live with the kids, whatever it happens to be. Another one, 48% of Americans aged 45 to 70 say they have no financial plan in place to protect themselves against outliving their assets and the rising cost of health care should they live longer than they expected. So the reality is we know people haven't done anything about it, or many don't have a plan for it. Well, this may be exactly the answer to that. But let's talk about one more thing before we do that. So what could contribute, rather, to the possibility of outliving your retirement income? It's different for everybody. Everyone has their own issues. Debt, historically low interest rates, where your investments just don't throw off enough interest. Stock market corrections. Everyone remembers when the 401ks became 201ks. Remember that joke? And that was real. I mean, everyone's defined contribution plans got cut in half overnight when the market corrected some 20 years back. Rising income tax rates. Right now they've actually gone down temporarily with the current presidency, but when you see the national debt keep going up, you have to wonder who's going to pay for all that, right? Social Security uncertainty. We've often wondered if in my family get to see our own Social Security benefits, will they still be around at that point in time? Healthcare expenses just continue to skyrocket. Everybody knows that. Not a lot of people are doing much about it. Political uncertainty, sure. I like this one because this probably affects Joe Lunchbucket in America more than anything else. They just didn't save enough to start with. Well, once you haven't saved enough, how do you catch that up, right? Well, this actually could help. And that's the Lifestyle Income Solution or the Longevity Rider. Here's basically how it works, and it's extremely simple. You can accelerate up to 10% of your death benefit per year. This can start happening at age 85 when you own this contract, and it essentially can spend down your entire benefit should you want to do that. So never before could you spend down your own death benefit without taking loans, without cashing out a policy or whatever. You're actually taking and spending your own life insurance death proceeds on yourself while you're still alive. And by the way, the question I usually get at this point is, and how does the IRS treat this, Mike? Well, it's because life insurance was designed to go to a beneficiary. The IRS basically looks at it as those payments will be tax-free up to the basis, but will be considered ordinary income after that. So let's look at what this looks like actually in an illustration. Here's someone bought a $1 million contract. They've been paying $8,000 per year all the way up to age 85. At that point in time, their contract's completely paid up. And the lifestyle income benefit column there is showing $100,000 payments coming out of the contract as the person moves on towards 95. So they're effectively giving themselves $1 million income stream over 10 years of $100,000 per year. So the 100% ROP idea at age 85 is this: instead of taking those payments forever, what we're going to do is stop the premiums of that income benefit at the point that it matches the premium outlay. At that point in time, there would have been no taxable event because it is considered return of the client's basis, so there's not a taxable event. And they would have somewhere between $600,000 and $700,000 of death benefit still left over should they not want to continue those premiums or that longevity right premium stream. In this way, you can present it to the client to say, we're going to get your premiums back at age 85 so that your net cost out of pocket ends up being zero, and you'll have roughly 3/4 of your death benefit going forward, guaranteed all the way to age 100. And that's a flexible option. Certainly, the client could have spent down their entire $1 million of death benefit if they wanted to. It's entirely up to them. If they didn't start the lifestyle income benefit or the longevity rider income stream, well, then it's $1 million of death benefit that's guaranteed all the way to age 100. Flexibility. This slide just is trying to demonstrate that the cash value at that point in time, if you were to try to pull out your cash surrender value, not surprisingly, would be a much smaller number, 2.5 times larger your pre-outlay, and instead you're pulling it out through our longevity rider. So again, the person in $323,000 in this policy over the 40 years that they had it, they're going to pull out, stop it at the basis, being the $323,000, and in effect have a return of premium at age 85, finishing this about roughly 87. So revolutionizing the way you sell life insurance, this is really a whole new way to show life insurance, right? Mr. Client, I'm going to do something that you need today. You haven't wanted to pay for it, but I'm going to show you a way you can get your money back, at least your basis if you want. And in fact, if you wanted to take it all as an income stream later in life, you'd be welcome to do that as well. And here's the protection spectrum that I think does a nice job of describing, I think, what a lot of people feel. Certainly not how I was trained in the business, I hate to say it, but close to 5 years ago this year, because we used to say, you really needed your life insurance for 3 things. You needed the income replacement in the income earning years. You're supposed to pay off the house, and that way if you kicked off early, your spouse would get the house free and clear, right? And you wanted to make sure your kids got a chance to go to college if college was in their playing cards, and that's what they wanted to do. Well, that's it, except fast forward to 2018, I believe it is still this year, and it turns out people have all kind of risk needs later in life. Hopefully they paid off the mortgage. Hopefully the kids did get through college. I have to say in my case, 1 or 2 of those will not be the case because I've got such young children. Certainly there's other risks that go on beyond the retirement age of 65 or 70. How about financial risk in general? The house doesn't care that you're retired and earning less money. If you need a new roof, you need a new roof, right? And those aren't cheap. Financial risk can be things like another market correction, kind of like that other list that we took a look at is why might people have financial challenge down the road. The second one really is something that I think most people are fearful of, and that's healthcare costs continue to skyrocket. How are they going to take care of each other? What if one of them has a chronic illness and they need skilled care? It's very expensive. Or what if they go to home? That's extremely expensive, right? So how do they deal with all that? And not last but least is that when one person of a couple pass away, their Social Security benefit is going to be drastically reduced. And so they're faced with the fact that at some point in time during the retirement years, the Social Security income check is going to be reduced also, even if everything's operating normally over at the Social Security days. So what we're suggesting is during the retirement, you actually do have some risk during the retirement years that should be covered and, of course, could be covered, and now we have a way to do it. So using our asset protector strategy with the GUL and the chronic illness rider and then the longevity rider, we can cover the big 3, right? Life insurance protection that can handle income replacement, mortgage payoff, college funding, and reduce Social Security income when the spouse dies. The asset protector lifestyle income solution, or the longevity rider as I like to call it, covers a multitude of risks and offers up an income stream later years for whatever reason. One of my friends often refers to this rider as the anything rider because it's not health dependent. If you live that long, you can turn it on should you want to. Market corrections, living longer than expected, didn't save enough, reduced Social Security, healthcare costs being out of control. You get it for anything you like, right? Unexpected expenses. Again, the roof doesn't check on you to make sure you can still afford to put another one on. If the roof wears out, the roof wears out. Ask me about furnace and AC. We just did that in the last 12 months here, and it's not cheap. Certainly, you could help grandchildren or just about anything you want because the money's yours to spend. The third category then, going back to the chronic illness rider, is that it helps take care of healthcare costs resulting from chronic illness. Again, 2 of the 6 activities of daily living or severe cognitive impairment. Studies show that 75% of people are going to fall into this category in their later years. 92% of seniors are going to have at least one activity of daily living that they're unable to perform. So it affects almost everyone. But this combination certainly, as you can see, provides protection a lot of different ways, but in ways that term insurance just can't cover. So the bottom line here, what we're saying is, if you can turn those term life insurance sales into permanent universal life sales and do on the GUL chassis as well, we have fully guaranteed program to cover clients whether they die too soon, get sick along the way, or live too long, right? But that's selling the value. Obviously, that it's easy for me to say, well, just don't sell term insurance, sell our GUL plan instead. Obviously, there's a large cost difference, right? The premiums are dramatically different. But if most clients understand the value that comes from this, I think that most people would agree that the asset protector combination really can create liquidity in a way that nothing else can. In fact, as my slide says here, if you've made the decision to buy permanent universal life, about the only reason you wouldn't buy our asset protector combination is because you simply couldn't afford it. Conversely, though, if you could afford it, why would you do anything else, and what else could possibly generate this kind of liquidity and value? And the answer to have a fully guaranteed thing is really nothing else. So we're pretty proud of this combination. Again, it's not a story that's told a lot because it's different. So you wouldn't have heard it from many other carriers because most carriers out there cannot offer this package quite like we can. So bullet number 3 there, when clients, especially premium payers, realize that they can spend their entire death benefit while they're still alive, most of your clients would never want to own life insurance any other way. So again, this is a great plan. It works very, very well, solves a lot of people's problems, and really that's what life insurance is supposed to do, right? It's not just a purchase, it's a solution. So hopefully this solution that we've shown you today, you would agree that really it provides an unmatched level of financial security, up to retirement and then going beyond retirement. So once again, we think it's worth it. American General is revolutionizing, I can't get through that word today, why people buy life insurance and how it's sold. So that is a very quick version of this presentation. Nick, are you still on the line?
Yeah, Michael, I love it. Thank you very much. What a powerful question to ask your client. What happens if you die too soon, get sick along the way, or if you live too long? What if I can put you into a product that will take care of all 3 of those at the same time? What a great information. Again, guys, thanks for attending. If you need any additional information, questions, concerns, please don't hesitate to give Dan or myself a call. Try us at 402-330-8700. And again, Michael, I appreciate your time. Or do you have anything you want to add there?
Just that we have a lot of good support materials. Some are client-facing, some are not. But certainly some of these really help set the table to get clients to realize some of the challenges that are in front of them and how they can be solved. So again, my favorite ones are really the ones that don't talk about any product, that just talk about people's challenges, the odds of you getting sick. 91% of adults have at least one condition, et cetera. So we have a lot of support materials for this as well. That was the only reason I wanted to throw that slide or two up there. That certainly can assist you as well. If we can do anything for you, certainly let us know, Nick.
I appreciate it. And guys, again, if you need any of this handout material or anything, don't hesitate to give Dan or myself a phone call. And again, we appreciate the partnership. Thanks. Have a good day.
Everyone have a